Most people think investing means buying whatever is available to the public and waiting long enough for time to rescue them. That advice is not entirely wrong. It is simply incomplete in a way that matters more every year. If you buy a broad index fund and keep feeding it for decades, you will probably do all right. You may beat many expensive managers, you may build a respectable retirement, you may avoid a great deal of foolishness. I respect all of that. But respectable is not the same thing as rich. And safe default behavior is not the same thing as understanding where the real growth now lives. That is the line I want you to hold in your mind. The public market is no longer the whole game. In many cases, it is the second half of the game. That is the mother line for this entire story. The second half. Most ordinary investors still behave as if the stock market is where the great growth stories begin. They imagine that when they buy the S&P 500 or dollar cost average into a brokerage account, they are stepping into the center of American capitalism. They think they are early enough, broad enough, smart enough, sensible enough, and in a narrow sense, they are doing the respectable thing. What they are not doing is owning the part of the cycle where the truly explosive value is often created. Now that part increasingly happens before the ticker, before the IPO, before the Robinhood app, before the index committee, before the public gets invited. That is the shift. And if you do not understand that shift, you will keep thinking you are diversifying into the future when in reality you are often buying a concentrated slice of the present after much of the best upside has already been privately consumed. Let us start with the illusion almost everyone still believes. Diversification, people say, the S&P 500, as if the number 500 itself were the protection. It sounds broad, it sounds balanced, it sounds like you are buying the market rather than making a bet. But the market is no longer as broad as the slogan implies. A handful of gigantic companies now dominate an astonishing share of the index. When you buy the whole market, you are in practice making a very heavy bet on a narrow group of mega-cap winners continuing to hold up the structure. That may work. It has worked spectacularly for stretches, but do not confuse concentration with diversification, just because there are 500 names printed on the label. If 10 names carry an outsized share of the weight, then the index is not a neutral field. It is a concentrated empire with hundreds of smaller attachments hanging from it. This matters because the whole sales pitch of passive public investing depends on the idea that breadth itself protects you. Breadth does help. I am not denying that. But when the top becomes more dominant, the index starts behaving more like a giant momentum statement about the current winners than a clean representation of the entire future. And history is much crueler to current winners than people like admitting. Every era believes its dominant firms are permanent. General Electric once looked inevitable. Kodak once looked inevitable. Exxon once looked untouchable. At the height of their power, ordinary people did not think they were making a narrow bet by owning them. They thought they were buying permanence. That is what every dominant era thinks until time reminds it that dominance and permanence are different words. Now, this concentration problem alone would be enough to make me pay attention, but it is not the deeper issue. The deeper issue is what disappeared. Where did all the public companies go? That is the question that changes the entire map. There used to be thousands more publicly listed companies than there are now. The public market was once wider, messier, more crowded, and in an important way more open to ordinary investors. More businesses entered public life earlier, more growth happened while those businesses were already accessible. The person buying public equities was not necessarily buying the leftovers of a private feast. He was often getting a seat while the machine was still accelerating. That is much less true. Now, the number of public companies has been cut down dramatically from its earlier peak. Meanwhile, the age and maturity of companies at IPO have increased. The growth phase that once unfolded in public now often unfolds in private. The 10 to 100x run that used to be available after listing is increasingly captured before listing, inside venture rounds, private equity structures, growth capital raises, founder control periods, and institutional networks. The ordinary investor never sees. That is the real insult. By the time the company finally arrives in public markets, much of the magical part may already be over. The public investor tells himself he is early. Often he is liquidity. That sounds harsh. Good, it should, because harsh truth is more useful than polite delusion. Now, why did this happen? Part of the answer is cost. Being public is expensive, not emotionally, operationally. Lawyers, audits, reporting, compliance, governance, disclosures, quarterly ritual humiliation in front of analysts who demand short-term certainty from long-term builders. All of it is costly, distracting, and often deeply stupid from the perspective of someone trying to build a business patiently. A founder looks at that burden and asks a very rational question. Why should I pay millions every year for the privilege of being judged every 90 days by people who did not build the thing? That question gets even sharper when private capital is abundant. Once venture capital, private equity, sovereign wealth, and large private pools became willing to fund ambitious companies later and later into their life cycle. The old necessity of going public weakened. A company that once needed the public market to raise serious growth capital could now stay private much longer and still scale aggressively. That changed everything. The best young companies did not stop existing. They simply stopped needing you. That is what ordinary investors still have trouble facing. They think the market is smaller because innovation slowed. The market is smaller because private capital got stronger. The most ambitious companies learned they could avoid the public stage until much later, sometimes indefinitely. And while the public kept chanting buy the index, the real early growth migrated behind a curtain. This is why I say the game moved. Public markets still matter enormously. They are liquid, regulated, scalable, efficient enough for most people, and still a respectable place to preserve and compound wealth over long periods. I own public equities. I respect them. But public markets are increasingly where you protect what you built. Private markets are increasingly where the builders get rich. That is the split. And if you do not understand the split, you may spend 30 years doing the respectable thing and still miss the deeper truth about why rich people seem to get richer faster. It is not always because they are smarter stock pickers. It is often because they are playing a different field. Now, I want to be very careful here because this is where naive people get intoxicated. They hear private markets and imagine secret unicorns, glamorous startups, artificial intelligence, rockets, and billion-dollar exits that happens. But that is not the whole private world. In fact, it is not even the most interesting part for ordinary wealth builders. The really interesting part is much quieter: private businesses, boring businesses, local businesses, cash-flowing businesses, plumbing, HVAC, landscaping, pest control, niche industrial service, logistics, maintenance operations that do real work for real customers and produce real cash. These businesses do not show up in your index fund. They do not trend on social media. They do not give TED Talks. They simply invoice, collect, operate, and compound. That is where I want your attention. Because a surprising amount of wealth is built not by buying the public glamour story at a giant valuation, but by owning the ordinary machine the public barely notices. The machine does not need to be sexy. It needs to earn more than it spends and keep doing it reliably. That is my kind of asset. An index fund requires immense capital to generate a serious annual income stream. If you want $200,000 a year from a public market portfolio using a conservative withdrawal framework, the capital base you need is enormous. Entire careers disappear into that requirement. People are told to save harder, contribute more, and hope the market behaves. Fine, reasonable. But there is another path. A small portfolio of well-bought private businesses can produce that same stream more directly if the businesses are real, the margins are solid, and the acquisition discipline is sound. That is not magic, it is ownership. The employee gets paid because he shows up. The index investor gets paid because he accumulated enough passive capital. The business owner gets paid because the machine earns more than it consumes. That third category is where fortunes have always been built. Now, why does 2026 matter so much in this story? Because timing in private markets is now unusually interesting. For years, private equity firms bought businesses aggressively using very cheap money. That was a beautiful environment for them. Borrow cheaply, acquire, improve, refinance, exit. Then rates changed, capital got more expensive, buyers got more selective, exit markets clogged, and suddenly thousands of portfolio companies stayed in private equity hands longer than planned. That matters when a seller needs to sell, and the easy buyers are fewer. The terms of the conversation begin changing. Motivated sellers create openings, long hold periods, create pressure. Pressure changes valuation, structure, and creativity. This does not mean everything is on sale. It means the field is no longer clean and easy for the incumbent professionals. That can be an opportunity if you know what you are doing. Notice the condition inside that sentence. If you know what you are doing. I am not selling fantasy here. Private markets are not a toy. Buying a business is not like buying a stock. It is slower, messier, more operational, more human, and far less forgiving of arrogance. You need diligence, you need structure, you need patience, you need to understand cash flow, seller motivation, financing, labor, transition risk, and what exactly you are buying. This is not for tourists, but for serious people. It matters that the field has opened up in ways that were not as visible a few years ago. And I want to say something else that most people miss. The barrier is not always money. Sometimes it is knowledge, sometimes it is courage, sometimes it is trust. A retiring owner may not want the highest private equity bid if that bid means gutting the staff and tearing up the culture. He may prefer a thoughtful buyer with a plan, with sincerity, with structure, with some seller financing and a real transition path. These deals happen not on television in the real economy. That is why access in private markets is often misunderstood. Yes, some deals are for institutions only. Yes, some opportunities are gated. But a lot of ordinary business ownership still comes down to knowing the landscape, understanding value, spotting transition signals, and being willing to speak to owners while everyone else remains hypnotized by public tickers. That is a different skill set, is a richer skill set. Now, let me make one thing absolutely clear. I am not telling ordinary people to abandon index funds and run blindly into private deals. That would be idiotic. Public index funds still have a crucial role. They are simple, efficient, low-cost, liquid, scalable, a wonderful default for preserving and compounding capital over time. I think of them as the defensive machine, the place where disciplined capital can keep working without constant intervention, but I no longer think they deserve to be treated as the entire universe of wealth creation. That is the real correction. Index funds are not dead. Dollar cost averaging is not dead. What is dead is the old fantasy that these tools alone still provide the same relationship to the growth engine of capitalism that they once did. They do not. Too much of the real acceleration now happens elsewhere first. That is the truth. So how would I think about it? I would treat public index investing as the base, not the ceiling. I would use it to preserve and steadily grow wealth, and then I would begin learning the private map with seriousness, not as a gambler, not as an ego project, but as an owner. In training, study local businesses, learn multiples, understand seller financing, read listings, talk to operators, learn what boring cash flow looks like, train your eye away from glamour and toward durable economics. That is how you mature, not by rejecting the public market, by recognizing it is no longer the whole story. This is the decision point. You can keep believing the kindergarten version of investing, buy the index, wait 40 years, hope it all works out. That will probably leave you okay. Or you can accept the harder truth. The field moved. The best growth often happens before public access. The public market is more concentrated than advertised. The boring private economy is richer than it looks. And ownership of real businesses is still one of the fastest ways to escape the life of merely earning and start living the life of actually owning. That is the whole lesson. The stock market is not a scam. It is simply the later stage of a game many people still imagine begins there. It does not begin there anymore. And the people who understand that first will stop asking how to squeeze a little more from the public leftovers and start asking a much better question. What cash flowing machine can I own before the crowd even knows it was worth looking at?